Ladies and gentlemen, hello and welcome to the Age of Alternates, a new series where we demystify the world of alternative investment fund and speak about unlocking new investment opportunities. In today's episode, we have Vineet, a manufacturer and fund manager, and Manu, an advisor to the advisors on the call. Manu is the founder of Centricity, a unique B2B2C private wealth platform that helps mutual fund distributors and wealth managers scale their business to private banking grade service through knowledge, training, digital onboarding, and analytics. Vineet is the founder of Everything Group, which manages over 7,000 crore in mid-market credit and has an impeccable track record of less than 0.1% NNPA. The group has invested in over 250 companies and brings a fresh perspective of granularity in the AIF industry. Gentlemen, we are excited to host you in the first episode of the Age of Alternates, and over to you for an interesting conversation.
Thanks a lot for a lovely introduction. Vineet, without taking much of our time, first of all, I would like to thank you for joining our education series on alternates. Vineet, you have been a pioneer in the AIF space, managing funds almost from the time SEBI regulations came in back in 2013-14, if I recollect clearly. As a person who has seen the industry from day one, can you help our partners understand how the industry has evolved across asset classes and size?
Thanks, Manu, for having me on the show. Glad to be here. You're right, SEBI came out with the regulations in fact back in 2012. And during my past avatar, when I launched our first performing credit funds back in 2014, it was a very, very, very small sector. I think the aggregate commitments on the industry in 2015 was only 25,000 crores. And from there, it has come to 7-8 lakh crores as on date. So clearly, in a space that has grown at a tremendous pace. Now, the space has grown at this rate because the market is huge. Even now, India's alternates as a share of the asset management industry on outstanding assets would be less than 5%, whereas the same number for a developed market in Western Europe would be anywhere between 30 to 45, depending on which market you look at, right? And therefore, there's a very good reason why why we have grown at a scorching pace. Not only have we grown at a scorching pace, but the maturity of the industry has evolved with time. Initially, during the early days, I used to see private equity and venture capital funds. It was a throwback to the VC era, which is where the original guidelines emerged out of AIFs from VCs. As time went by, venture debt started building up as an asset category. Arbitrage funds began building as an asset category. Real estate funds started showing a lot of maturity and performance. And today, you have a melting. You have real estate, you have private equity, venture capital, arbitrage, performing credit, distressed funds, special situation funds. So it's now a much more robust and active industry with a large number of fund managers. So I think it's been a great last 9 years or so since the guidelines first came in place.
There is a lot of still lack of awareness between the VC, the performing credit, the revenue-based financing side. While not really going into the detail, an obvious question which comes to the mind from a person who's listening to the podcast: is there any kind of an overlap which happens in this space, or these are very, very classified segments of investing on the high yield debt side as an overall category, if one would say?
Great question, and that goes to the heart of how we think about investing and product creation. We look at the entire spectrum along a lens of risk and return. So if I can mentally ask you to imagine a graph where you have, let us say, returns on the x-axis and credit ratings on the y-axis, which is a kind of a metric of risk and return, you will see that on the extreme left, bottom left is mutual funds, lowest on return, lowest on risk. And then as you move towards the right, you start seeing performing credit, then you start seeing venture debt, distressed debt, and finally private equity. So very clearly, these are distinct segments.
Okay.
And usually we see that fund managers specialize. So there are better debt fund managers, there are special situations fund managers, there are private equity fund managers, there are performing credit fund managers, each of which has their own strength in sourcing, in assessment, in portfolio management, in finding and the right opportunities, in structuring those investments, and therefore creating the right value proposition for clients. It's rare to find managers that do everything. In fact, our experience has been that when people try to straddle different parts of this ecosystem from the bottom left to the top right, the same graph that I outlined, success is limited, because in asset management, I think the client likes to see specialization.
Yeah.
The client awards a manufacturer for specialization, because each market carries its own complexity, its own regulation, its own risk-return conundrum, and has very unique portfolio management requirements. So globally, as well as in India, the market awards manufacturers for specialization and not for straddling multiple parts of the ecosystem.
Great. With the specialization as the last point, we have seen how Vivriti has grown over a period of time and how you have taken it forward. And we all are presently surprised and comforted by your investments in team, technology, with an investment team of over 50 and total employee strength of over 300. Are you planning to add newer asset classes also?
So we are a specialist in performing credit. We work with operating companies. We lend to them against their cash flows. We finance them for growth. And to my mind, the market opportunity is so large that has forced us to evolve and grow and add a lot more capacity as we went along. Because the profit pools and the kind of discontinuity in return over risk is what makes this segment very attractive. Okay. Let me explain that in a very simple illustration. CRISIL, which is the top rating agency in the country, over a 20-year period has demonstrated that BBB rated companies are 3% more likely to default than the government of India. However, in the market today, BBB bonds would give a return of more than 8% over government of India. Right? So therefore, the value proposition of the segment is instantly obvious, that if you were to create and curate and identify a portfolio of BBB bonds, which is essentially mid-market companies performing credit, you could actually deliver a return to investors that is far exceeding the risk of that portfolio, which is what we are all working for, right? So we specialize in performing credit. This is a space that has today an opportunity size of 18,000 EBITDA positive companies across the country. We see absolutely no reason to add more asset classes to this mix. And the reason we have the kind of team strength, technology, people is because of the scale of the opportunity.
With 18,000 as a pool which you are referring to, but practically as an investor, what is the kind of an accessibility till date they would have garnered through specialized fund managers like you? I mean, any sense? Because that's a huge number, 18,000.
It's a great question, and you'll be surprised to know that if I take the aggregate of Indian bond markets, right? India has a $600 billion bond market. In $600 billion, the total share of BBB is less than 3%.
Okay.
Right? So that is an immediate numerical answer that this segment has not found its way towards the balance sheets of HNI investors, right? Because there is a lack of specialized fund management capability that can find these companies, that can bring them to the market, that can structure these transactions and create these portfolios. So a different way of answering your question, there are very, very, very few performing credit fund managers like us today in the market. It's still a small segment. It's growing rapidly. We are growing rapidly, but we are discovering things as we go along.
With this opportunity of 18,000 odd companies, both the sides will be benefited. The investors who have the opportunity to invest, and the companies can also garner capital for their future growth and other things.
Absolutely. As I was saying, Manu, this is a space that shows unlimited potential because India, as a $600 billion bond market, has only a 3% share of triple Bs in it. And therefore, very, very clearly, triple B issuers of the kind that we speak about have not found their way into HNI balance sheets at all, right? And therein lies the opportunity. Here are entrepreneurs who are hungry to grow, who are the Indian economy, who definitely need debt capital, and therefore it is the job of fund managers like us to be able to find and curate these opportunities and bring them to investors' balance sheets over the next several years. Now, the market opportunity for the space of 18,000 companies is north of 10 lakh crores over the next 2 to 3 years. And very, very clearly, it needs a massive amount of capital and far more than what perhaps a Vivriti can do to bring in that kind of capital to these companies. So we need several such firms like us to do what we do.
Great. Now, one of the very obvious questions which comes to our minds is that traditionally in India, on the debt side, I would say the bread and butter product has been by and large the mutual fund. So I'll just stitch two questions together for you and probably have an answer at one go. With the macros and geopolitical tension distorting liquid asset class prices more frequently, there is an increased interest from investors and advisors alike on the alternate side. So can you give a bird's eye view of the industry? That's one part of the question. And do you feel that MLDs and unrated bonds can be counted as alternates investment? And are AIFs an alternate to MFs or bonds also?
All good questions. And let's go in the same sequence. Firstly, taking a bird's eye view of the entire credit space, that's outside mutual funds. There are certainly direct bonds, which are either bonds or market-linked debentures that investors can directly participate in. Today, SEBI has permitted participation at a ticket size of 1 lakh, which means that a retail investor with 1 lakh to spare can buy a bond today if they choose to. The second is the entire PMS space where people hand over their corpus to a single PMS advisor who could invest in the fixed income markets on their behalf. And what is now gaining a lot of steam is AIFs, which can be compartmentalized into performing credit, into special situations, into venture debt, into distressed debt, and into real estate, which are specialized funds in a certain single asset category. Now, each of these parts is witnessing their own level of growth over the last 10 years or so. Venture debt, performing credit has probably been growing faster than other segments in this market. Real estate goes through its own cycles, and therefore real estate funds also go through their own cycles of fundraising. But performing credit today is finding a lot of momentum in the market. Now, I do believe that there is a distinct difference between buying bonds and buying bonds through an AIF investing in those bonds, right? And the way I look at it is as follows. Private companies today do not necessarily need to disclose a lot of information about themselves. And therefore, for an HNI to directly invest in a single bond, right, to my mind, would probably be not the right way to approach the credit market, right? Investing in a AA or a AAA bond from a listed company would mean that the investor has access to a lot of information and is on par with any fund manager. Whereas in the lower rated private credit space, institutions have a significant advantage over an individual in terms of their ability to assimilate, understand, assess information, assess governance risk, assess market realities, conduct physical diligence, etc. And therefore, it would make far, far more sense for the said HNI to invest into a portfolio of bonds managed by someone who has taken fiduciary responsibility through an AIF structure. And that's why we believe that an AIF is a far superior alternative to a private credit direct bond investment by anyone, any HNI. Today, AIFs hold both NCDs, AIFs hold MLDs, AIFs hold commercial paper, securitization. So there are a host of debt instruments that AIFs can hold. And if it were, for example, a category 2 AIF, then the taxation would be completely passed through. If it's a category 3 AIF, then the fund pays tax on behalf of its investors. But at the end of the day, today we believe that this is the product that should actually find its way into investor balance sheets rather than direct lower rated bond investments.
Also, we have been seeing you have invested into technology, you have a large team. We at Centricity follow a digital onboarding and a physical hand-holding of our partners. Where are you exactly in terms of your digital readiness?
Great question. And I think that goes to the core of how we see the market evolve over time. Because we believe that at some scale, AIFs should be as easy to invest as a mutual fund is today. Today, if you or I were to want to invest into a debt mutual fund, we would open our, let's say, our personal banking account in ICICI Bank, directly traverse to the investment section, find a fund and invest.
Yes.
It's as easy as that, right? Now, we envisage a future where it should be equally easy for anyone to invest into an AIF, which means that AIF units should be dematerialized, they should be listed on a bank, onboarded by a bank, and therefore investable directly through a bank account integration with any onboarding engine. Vivriti has launched its own onboarding engine around a couple of months back. Today, any distributor or any investor can have a fully digital journey from selecting a fund to getting themselves onboarded, getting their agreements signed digitally, to also investing digitally as well. And we would like to take it a step further by bank account integrations. We would like to take it a step further by providing portfolio analytics. We would like to take it a step further by also enabling dematerialization of fund units that allow for leverage, allow for secondary market sales, allow for redemptions, right? So we have a technology team of around 20 odd engineers, and this is a growing team headed by a very experienced CTO. Who are building our platform as we go along. We would love to have the opportunity to integrate with the Centricity platform as well, because we think that your engine coupled with ours could really reach deep into tier 1, tier 2 cities, which today we think are significantly underserved.
Well, absolutely, we are with you on this. And interestingly, I just wanted to understand on a little bit more on the dematerializing part. Has it been already practiced, or it is work in progress right now? Dematerialization of AIF units.
It's beyond work in progress. Our first fund, Samarth Bond Fund, has already been dematerialized. So there's an ISIN that's issued. The first experience took us 2 months. Okay. So it's not as well understood even by the depository as a bond demat is as of today, right? So it takes effort to do it, but to my mind, now that we've done the first, it should be a matter of days before we can get all our funds dematerialized.
Yeah, it's quite obvious. That's how it works.
Thanks, Vineet and Manu, for an incredibly interactive conversation. It was great to listen to Vineet's trailblazing insights on the growth drivers of the sector and the groundbreaking work that they are doing in the creation of performing credit category. I hope you, our listeners, have been thoroughly captivated by the conversation as well. In the upcoming episode, we have Vineet asking Manu his experience in the category and about all the phenomenal work that they are doing. Stay tuned, and we look forward to seeing you in the next episode.